And with stocks falling, investors looked for quality in treasuries. They rallied with the 30-year bond seeing the biggest gain, sending the yield to 4.5%. Given that stock snapped a 4-week winning streak, is this a sign that the rally from the March lows is over? Let's bring in, for the answer to that, Zara to wrap up the week. And Zara, it seemed like the bears definitely won out over the bulls this week.
Well, Investors Intelligence talked about the number of bears increasing for the first time in a month on Wall Street. And if you look at the best performing groups this week, definitely defensives in play. Healthcare, the only one to gain of the group. Technology, which some people are thinking more and more is a defensive play given its performance in this recession. Plus consumer staples and utilities, which are often seen as a place to park your money when you expect that the market is going to get worse. Some investors definitely had that view this week.
I think the bear market has a lot more to go. Some people think that's bad news, but as long as you're on the sidelines and safe, it's not that bad of a situation, because ultimately you're going to have the best bargains of a lifetime when this market finally does reach its final bottom.
But despite the pessimism, there were some indicators that there would not be a correction, meaning that a fall of 10% from current levels. One of them was the S&P 500, shown in the orange line, just bouncing off that 200-day moving average shown there in the blue line rather than dipping below it. Bespoke Investment says that that signals this is a good entry point for investors given this week's down market. Steve Luthold, whose core investment fund has beaten 95% of its peers, would agree with that, and he says stocks could rise another 20% by the end of this year.
You're going to see 1,100 by the end of the year. I wouldn't really start hedging or getting net short in this market until year end and maybe through mid next year.
Luthold says the one risk is inflation, but that's probably a year or two down the road.
Hey, we had a lot going on in Washington this week, obviously. How much impact did that have on the markets?
Well, especially as far as the financial regulation, of course, nobody likes that when it comes to what it's going to do to profitability. This is basically trying to give more powers to the Fed to monitor the biggest banks and provide more regulation for the hedge funds out there, plus more protection for consumers. Treasury Secretary Geithner, he was saying, you know what, this is a priority for the administration.
I don't think we can afford a situation where we leave in place vulnerabilities that will sow the seeds for future crisis. So we look forward to working with this committee in the weeks and months ahead to put in place a stronger foundation for a more stable financial system in the future.
But even S&P agreed that this would hurt the banks. It downgraded 18 banks this week, many of them regional banks. And you can see what it did to the index there. Because of this tighter regulation, they're thinking that more capital requirements could crimp profits. And of course, Matt, they need these profits to kind of recover from the losses. Remember, we're looking at about $1.4 trillion in write-downs.
All right, Zara, thanks very much for that.